So entries are pretty much one of the last things that we're looking at, right? We spoke about this at the very start of the module in that introductory to technical analysis lesson, where essentially we need to build the story right first. So if I just kind of put up the sort of main areas of confluence that we look at, right? Market structure, as we know, always comes first. That, in my opinion, when you're starting to build a trade idea, no matter what strategy you trade, market structure always comes first. That is the main confluence. Then we can look at our supply and demand zones, right? And we want to see where they are positioned within market structure. Are we playing pro trend, counter trend, etc., etc.? Then last, we can kind of start to look at, not last, but after that, we can start to look at liquidity concepts, right? The two main ways that we use that, one being for those sweep zones, and the other one being, do we have inducement in front of our zone? And then finally, probably the kind of last major confluence I would look at is pricing. How well priced is the area that I'm looking to trade from? So that was how we used our premium versus discount tool, right? So obviously spoke about that in the market structure module, but I would kind of view that as its own sort of separate piece of confluence, and that is essentially the order of importance in which I would use to personally start to build a trade idea, right? So that's pretty much what we've gone through so far in the technical analysis module, and you've learned all of those individual concepts, but we've learned it in a way where we've kind of built each of those concepts on the prior concept, right? And we've built that story along, and we've slowly put it together throughout each sort of sub-module and lesson, and you saw trade examples kind of the whole way through that. So you should have a pretty kind of good grasp before even watching this lesson in terms of how we are looking to use all of that, but also how we are looking to actually enter trades. So this lesson specifically isn't going to really be about that. It's not going to be about looking at all of those pieces of confluence and how we build those trade ideas. What this lesson is about is that once you've already done that and you've done the hard work and you've built the whole story, right, the whole higher time frames, how they're pieced together, where we are within structure, etc., etc., and you've identified and refined the exact zone that you wish to trade from in terms of your higher time frame POI, right, your point of interest. Then obviously there's a few options that are going to be available to you in terms of how you specifically can enter that zone and execute that trade. And that's what this lesson is going to be about. So again, it's not going to be about putting all of that together so far, but more so once you've built all that story and you've got the zone or the area in which you want to build a trade idea around, and when you actually want to start to execute a position, this lesson is going to be about kind of those options that are available to you. Then when we get into the next section coming up, which is about trade plans, right, creating and building your own specific and personalized trade plan, that is where we will then talk a lot more around, putting it all together, what confluence you want to see and you need to see as minimum criteria, or what is just, additional positive confluence, but you don't actually need it to execute a trade. But more specifically, what time frames are you going to be trading from? What constitutes a high time frame POI for you? And then what lower time frame are you going to use for execution? Because for some people, they'll be using 4-hour structure, they'll be using M15 POIs, right, to build their trade ideas around. But then once the price is in the M15 POI, that's when they'll then be using, say, the M1 or maybe lower for their actual execution. Whereas other people may be, using the weekly, the daily, and then the 15-minute for execution, right? So all of that is pretty much irrelevant for this specific lesson because we're going to get into that in a little bit coming up. But this is, like I keep saying, right, this is just going to be about once you've done the hard work, you've built that kind of, that area in which you want to look to execute, how can you actually get in, right? So let's dive into that and drag this across. So there's kind of two main sort of entry types, the way I would classify it. One being a risk entry and the other one being a confirmation entry. Obviously there's three here, so you're probably thinking, why are you saying two? Well, the double confirmation entry for me kind of just gets looped in with confirmation entry. But yeah, let's just dive into it and talk about it. So the first one being risk entry. So this is very, very simple. So essentially you have your higher time frame POI, in this case the supply zone, right, denoted by this grey box. Now, like I was saying, right, higher time frame is any time frame. It's going to be specific to each individual trader. A higher time frame for one person could be the daily, for another person it could be the M15, right? And then your lower time frame is just sorry, let's put my phone on silent. There we go. Your lower time frame will then just be whatever lower time frame is going to be lower than the higher time frame one that you use at. So in this case, regardless of whether this is a continuation zone or a reversal, so obviously if it was a continuation, we would have price moving to the downside, right, forming a lower low, price would be pulling back up into the supply zone, right, that caused that break of structure, and we'd be looking to get short here to then try and potentially catch this lower high, right, to then get that next break of structure for price to form a lower low. So that's the idea with that. Or of course, if it was a straight reversal, so if price was trading to the upside and then price came down, we had that reversal, and then we could be looking to trade in here to try and catch that lower high. So it's irrelevant of whether it's a reversal or continuation. What essentially makes this a risk entry is that you were just looking for price to pull back up into that higher time frame POI, and you were looking to just whack a limit order on, right, anywhere on or within the zone, and then you're essentially hoping that price is then going to reverse, tag you in, and then go in your favor. Okay, so we'll talk kind of a little bit further on in this lesson about a bit more about the specifics of exactly where you can enter within the zone. But right now, I just want you to concentrate on essentially you're just identifying your higher time frame zone, and you're just looking to enter on it, put your limit order on it, and that essentially is your risk entry. So remember, your stop will always go behind the zone, and then your entry can be anywhere on or within the zone. Okay, obviously the more refined you go, the better the risk to reward you get, but the more you increase the probability that you may not get tagged into a position. So that's your risk entry. Now a lower time frame entry will be, sorry, not lower time frame, a confirmation entry or a double confirmation entry is essentially where you would then drop down to a lower time frame once price enters your higher time frame POI. So in this case, the minute that price gets to here, where this orange line is, right, the very edge of our higher time frame zone, I would have an alert that would ping off. I would then drop down to my lower time frame, my execution time frame, whatever that may be. Okay, and then I would start to wait for price to switch bearish in line, right, with the higher time frame intention. If I'm looking to catch a lower high, price is fractal, the lower time frames will switch bearish first, okay, and we'll see that, and then that way we're using that little bit of extra confirmation in the lower time frames because we're looking for, you know, that bearish order flow starting to kick in. We're looking for demand to start failing, right, supply to start taking control, and we're going to see that first on the lower time frames if this higher time frame zone is likely to hold, right. So if there's supply in the zone and we're going to look for that next move to the downside, we're going to see that first on the lower time frames, okay? And that's essentially all we're doing, and that's, you know, this is why it's a bit riskier, because price could obviously just, you know, we don't have any confirmation. Price could come up into here, move a little bit, and then just stop us out. And the same thing could happen here. We could still have all of this confirmation and price could still go and stop us out, but at least we've had a little bit more confirmation on the lower time frames, and we're seeing that fractal bearish order flow start to kick in, and this is why this can be useful, okay? So very simply, confirmation entry, price comes into our higher time frame POI, we drop down to our execution time frame, we wait for you know, essentially price to start breaking structure to the downside. So a confirmation entry is when you get that first break of structure to the downside, price then pulls back up, in this case into a supply zone, and then we would look to get short from that first zone there, right? And that would be your confirmation entry. And then, as the name suggests, a double confirmation entry is then when we have that double break of structure. So we have that first initial break of structure, we then see price pull back, tap into supply, and then we get another break of structure, and then that secondary supply essentially is your double confirmation entry, right? And then, you know, I guess technically you could keep doing that, right? And then you would get a triple confirmation entry, so on and so forth. So yeah, you can either enter on the confirmation entry, or you can wait for even more confirmation to get that double confirmation entry, and that could be your first initial position. Or of course you could enter on both, and you could use that to just scale in. And really, that's as simple as it is, okay? It's just kind of a way of classifying how you may want to approach, you know, that higher time frame POI, because you could see this, whether it be the 4 hour, the M15, whatever time frame you like to use, and it's kind of essentially two options. You either just want to get in on that zone, you just want to enter anywhere on or within it, stop always goes behind, or you want to wait for a little bit more confirmation, you'll drop down to a lower time frame execution, your execution time frame, and then you can look to either just take that first break of structure to get the confirmation entry, or that double confirmation entry. Now, one reason kind of why you may want to wait for the double rather than that first confirmation entry is because what can happen, so if you just kind of imagine this bit of price action here, is price comes up into your higher time frame POI, we then come down, right, and we get that break of structure here, but then what can happen is price can come back up, and you could be looking to get short from this zone, but price could just continue up, right? So then it ends up just grabbing that liquidity beneath that zone, right, to then fuel the move and then sweep the liquidity above this high, and then we get the real move going. So that's why waiting for, you know, another break of structure to the downside first can kind of boost your strike rate, or you may wish to do so. You know, if you don't have a lot of confidence in that specific POI, then you may want to see more confirmation and wait for that double break of structure just to stop you getting caught in a potential liquidity sweep here, right? If you tried to get short from that supply zone and then you get stopped out before the real move goes, okay? So yeah, that's pretty much it. That's kind of as simple as it needs to be. You don't need to overcomplicate it any more so than that. Now, one thing I do want to add to it, kind of just a very kind of nuanced difference between risk entry and confirmation entries here on the lower time frames, is that when price comes into your higher time frame POI, so we look at this kind of first entry model here, just like we saw, right, price comes into it on the lower time frames, right, we then get that break of structure, price then pulls back. Now it doesn't come up straight away to that first supply zone that's created, because remember, if price came up to here, that would be our confirmation entry, right? But in this case, it doesn't quite pull back up to that supply zone, and then we get that second break of structure. So now we have that double break of structure, we now have our second supply zone. Now we can definitely look to take this double confirmation entry here, right? And we can look to get short. Now what can happen, as you can see, is price can then come down, it can break that low here, right? We can get another break of structure, but then price can come back up. This would then stop us out for break even. But then what happens when price comes back up? Well, it has to switch bullish, right? Because it has to break that lower high, which then forms a higher high in order to come back. I'll get rid of the orange line. In order to come back to the initial zone that we were looking at, right, the origin demand zone of that move, price has to switch bullish to get back here. So you definitely can look to enter here. You know, we've had the, especially if you know, like for instance, we get a sweep zone, price sweeps liquidity, taps into a higher time frame POI, we get multiple breaks of structure to the downside, and then yes, we could look to get short here as well from that double confirmation entry. Pricing comes down. We then move to break even as we get a break of that low, or we can partial out to move to break even. Again, we'll talk about management in the next lesson. Essentially, price will come back up, stop us for break even, and then we can look to enter from this zone here, and we can put a limit order on here, right? But you have to understand that price on this time frame, on your execution time frame, once it breaks this high here, it has now switched bullish again at this moment. So order flow is bullish. Technically, that lower time frame demand is now in control. So as you're trying to short here, it's a bit more riskier, right? Because you don't have that confirmation. But this is a valid trade. I'm not saying you can't take this, but you just have to understand that this is a risk entry compared to if price came down here, that first initial break of structure, then came into the zone, and then you got short from here. That would be classified as a confirmation entry, okay? Because price is bearish, it's in line with the direction in which you were trying to trade. But when price then comes back, uses that prior move as liquidity, right? Forms those equal highs, then price comes back into it. That is then your risk entry here. Now this entry model over here is the exact same entry model that we have here, except once it actually comes back up to that zone where initially we'd be looking to take a risk entry, what you can do is you can wait for price to switch bearish again on their execution time frame. So then when it gets that break of structure again to the downside, price is now bearish, supply is back in control, and essentially you're just using a confirmation entry of this zone, right, to confirm that the supply is going to hold, wait for that break of structure to the downside, supply is back in control, and now you can look to get short from here with that confirmation entry. Okay, so you can do this on this exact same time frame. So for instance, let's imagine that this higher time frame is a 4-hour chart, and then you were looking to enter on the M15. So that was the blue line. Here, this would be an M15 risk entry. Over here, you would then wait for price to come into that zone. You would then wait for price to then switch bearish, create a new supply zone. That would then be your M15 confirmation entry. But you don't necessarily have to use the M15 to see if this M15 zone is going to hold, because price could come up into your M15 zone here, and then you could drop down to say the M1 or the M5 or whatever you want to use, wait for the M1 or the M5 to switch bearish, and then enter here on the M1, right? So you've used that M1 to fractally confirm this M15, to fractally confirm, right, the 4-hour. So you can understand and see how you can use those different timeframes together. I know it can be a little bit confusing when you kind of first think about it, but really just want you to kind of see the differences here between a risk entry and a confirmation entry. And kind of, I guess, the most simple way I could define it is that a confirmation entry is when the time frame you were looking to execute on is essentially you're trading with the trend. You're trading that continuation, rather than this kind of being this would be a straight reversal because price is bullish at this point as you're trying to short it. Okay. So then let's take a look at essentially the kind of pros and cons between when to use a risk entry and when you may want to use a confirmation entry. Now, kind of just laying this out here for you guys to think about. It's going to be different for every trader. Some people may only want to use confirmation entries. Others may pretty much only use risk entries. Some may use a combination of both, depending on different factors. So let's kind of go through those, and then you can kind of see, why you may wish to use one over the other, or in specific circumstances. So A risk entry, as the name suggests, it is slightly riskier, but that doesn't necessarily mean the reward isn't there. Okay, so essentially, if I could boil it down into the simplest way you can use it, is you would identify your higher time frame point of interest. Now what you can do then is, let's say this was your 4-hour zone, is you could refine your 4-hour zone just to make it a little bit more smaller and more accurate by jumping down a lower time frame, looking and investigating this section of price action on, say, the M15. And then on M15, you may actually see, well, this is where the actual true supply came in. You would use your confluence to then identify this M15 zone that is stacked and nested within your higher time frame zone, right? Your 4-hour zone. So now what you have done is you have used multiple time frames to refine your higher time frame POI to a lower time frame POI, and then that means you can whack your limit order with a slightly smaller entry, or risk reward, I should say, right? Rather than entering on the distal of the 4-hour zone, and obviously it's going to negatively affect your risk to reward. So that's obviously optional. You don't have to do that. You can literally just stick to the 4-hour zone, and then obviously once you're happy with it, set your limit order on the zone. Now, this is best used, in my opinion, when you are trading with the trend. So essentially, those continuations, because you're increasing the probability that price is going to hold, right? We know that it's more likely that structure is going to hold, that if price is trending to the downside and forming a series of lower lows and lower highs, that it's more likely that a lower high will form here, right? So that's why, without waiting for that lower time frame execution like we can with the confirmation entry, this is why using risk entries with the trend, hopefully it's pretty obvious of why that you would be more inclined to use it this way. Best used when you can refine that higher time frame zone with a lower time frame zone that's nested within it, essentially just to increase your risk reward and decrease your accuracy of entering at the right point, right? Best used when you kind of just want to be aggressive, if it's a zone you really like, and price action is just there's tons of positive confluence and you just want to get in, you want to be aggressive, then just being whacking on your risk entry limit order can be good. And kind of finally, I guess, your trading personality or your routine. Let's say you're busy with work, you have a 9 to 5, or you're someone who just doesn't want to be on the charts a lot. Set and forget. You can identify a high time frame POI. It could be the weekly, the daily, 4-hour, whatever, even M15. You're going to have probably hours and hours, if not days, to sometimes spot these zones that you want to enter from. And instead of waiting for price to get back there, then having to jump down a lower time frame, wait for all of this to realign, then set your entry order. Have to be in front of the charts. Instead, you could see this, the night before. The 4-hour chart could then be trending to the downside. The next day or so, it can pull back. Your entry order's been there the whole time. Then you're tagged into the trade. Ideally, it runs into profit. And it's a much more hands-off approach. And that's really kind of where risk entries come into their own. So I guess the main kind of obvious benefits to using risk entries is that you can get into trades that sometimes literally price can come into a zone and it can just tap and go very, very aggressively. If there's a massive imbalance within that zone, right, an overwhelming amount of supply compared to demand, obviously in this area, then this is where it can be beneficial. Sometimes you just kind of miss that confirmation entry, and sometimes you will miss the move. You can obviously get a high risk reward if you have managed to refine your POI to a lower time frame zone. And just more generally, kind of that autonomous execution, that independent execution where it's a lot more hands-off, a lot more set and forget, which some people will definitely prefer that approach. It can also be a lot easier on your psychology as well for some people, because you set your order and you walk away. Rather here, you kind of have to be a bit more active, and you can kind of potentially talk yourself out of trades or make a few mistakes in the heat of the moment as this is kind of happening. But other people find risk entries a lot harder on their psychology, because you can take some losses if you haven't identified high enough probability zones, and some people just prefer to always wait for that bit of extra confirmation, as they just gives them a bit more confidence that the zone's holding. They're seeing what they want to see in the lower time frames, and they prefer it this way. So this is why there's a million ways to trade the markets to make money, and obviously we'll talk about this a lot more in the trade plan section. But I just want you to start kind of thinking about the benefits and the cons to each. There's obviously always pretty much equal benefits and drawbacks, right? You just got to figure out what is going to work best for you and kind of what makes most sense to you. So the main cons are, just like I was saying, you don't really get any confirmation, right? So price could literally pull back and just blast straight through you and stop you out. And also you can kind of generally get lower risk rewards if you haven't refined it to a lower time frame zone. Or of course, if you're waiting for a confirmation entry, you can go down to a really small time frame to wait for that bearish switch in trend to then get a very, very small stop loss to give you a really high risk to reward. So in terms of the confirmation entry, Pretty similarly, you would obviously identify a high time frame POI using all of the confluence that we've looked for in the previous lessons, market structure, yada yada yada. Then you can refine on the lower time frame again, just like we did here. I haven't drawn it on this case, but you could, if I drag it across, you could, rather than just waiting for price to come into, say, your high time frame zone and waiting for, say, the M1 to switch bearish, instead you can wait for the refined zone within your high time frame zone to be hit first before you look for your entry model. Because what could happen is price could come up into your high time frame zone like this. It could then switch bearish, and then you could look to get short here, right, from this zone. But it could be a bit of a liquidity grab. Price could go higher and then tap into the actual refined zone, right, within your high time frame zone. Then you get the break of structure. Let's say this was a little high there, sorry, a little low there. Then you get your break of structure here, right? Now that wasn't a full signal. All of this was just a run on liquidity there. And then there you have, much higher confluence that price is likely to tag you in and go, because it's, mitigated that kind of last bit of refined supply that you've done. So refining is obviously optional. You don't need to do that. Once you've got your zone that you like, you obviously wait for price to reach it. Then you drop down to your execution time frame. So it's kind of denoted by this blue line here. So let's say your hard time frame zone was a 4-hour zone. You then drop down to the M15. For instance, you'd wait for the M15 to switch bearish, pull back into that first supply zone. That would be your first confirmation entry. And you'd set your limit order on that newly created fractal lower time frame zone, and then you've got a bit more confirmation that this high time frame zone is going to hold. So this is kind of be, if you were going to use both types of entries, confirmation and risk, then this would be better to use it if you're kind of trading counter trends, because obviously there's less probability compared to pro trend trades that this zone may hold. So you may want to just wait for a little bit of extra confirmation, just to show that bearish order flow is starting to kick in if you're looking to get short. Also good if you have a large high time frame POI. So kind of what I mean by that is, imagine this is a daily or a 4-hour zone. Generally those zones, depending, obviously going to be different for every pair, but generally those zones can be anywhere from 40 to 100 pips, for instance. And if you're using the M1 for your execution time frame, the minute it gets into here, like I was just saying, and you trade that first break of structure and that first flip, your increase, well, it's a lot lower probability that necessarily that first move is going to be a true signal, and you could take a lot of false signals as price moves deeper into that kind of 100 pip zone before eventually it goes. So this is kind of when it's pretty decent to use those extra confirmation entries, and to use those refined POIs to make sure that you don't get trapped in those false signals, but also to increase your risk reward. Because let's say you wanted to take a risk entry on that 100 pip daily zone, obviously your stop loss is going to be much larger than when you can actually refine it to your lower time frame entry zone, which is obviously going to be much smaller than your high time frame zone. It's also best used when price is moving very aggressively into your high time frame POI. So if you can kind of get that V-shaped move where price moves down and it comes very, very aggressively with all the momentum back into your zone, you may want to just not take a risk entry with that and actually wait for that lower time frame confirmation to start switching bearish, just to give you a bit more confidence that price is going to hold. And then another really good one is if you have multiple POIs to consider. So for instance, let's say price comes to the downside, and then you have, let's say, your origin zone up here, and then you may have a couple of decisionals, right? You could literally have one around here, and then you could have another one here. Sometimes you can have even more, and then obviously this is the most well-priced one. There may be decent confidence for all of them, and you're not quite sure which one is going to hold, because price doesn't have to come to the origin. Then what you can do is you could just trade any confirmation entries that you get. So maybe price just comes up into this one, it blasts straight through it and never switches bearish. It comes into the second one, and then you get your entry model. You could take that, and then you're in, right? So all you were doing is you set alerts on all three, and you just trade your entry model once you get your confirmation entry to confirm that zone's going to hold. Then you can get in. And what you may also want to do is that whole time is you may want to set your risk entry on the top one, right? Because if price is going to form that lower high, then this is the last point at which it's going to do it to maintain that bearish trend, right? Because this in theory should be a strong high. So if you have multiple POIs, kind of one thing you can do, like I was just saying, set your risk entry here and then trade confirmation entries from the decisional. It will again be very dependent on kind of each individual trade setup, and also what you have in your plan. So the main benefits of this is obviously additional confirmation and higher risk to reward if you are entering on a refined lower time frame POI compared to just entering on the whole zone as itself. Main sort of drawbacks are you can miss moves that do not pull back. So that's what I was saying here, right? Sometimes price can just come in, tap, fly, and it's off, and you won't always get pullbacks to those lower time frame refinements. And then finally, it can be where you just can get trapped in false signals, where price can kind of give you that first initial confirmation entry and then push higher and deeper into the zone before you get that real move, as it was just a liquidity grab. And that's kind of really it. The main differences between risk entry and confirmation entry, but this was just something that you'll get used to with time and experience as you test more. And obviously it will depend a lot as well on your own personal lifestyle constraints, if you have a job and things like that. So kind of again, if I could just kind of simplify it, the way we can trade, you can overcomplicate things a lot. And I think this diagram is kind of a good way to kind of summarize of what, again, we were trying to do here. So we have our higher time frame denoted by this black line. We have price trending to the downside. This is obviously a weak low because it failed to take out the high. This is a strong high because it's taking out the lows, right? So it should be protected in that bearish trend, so on and so forth. Price pulls back into our supply zone here. It fails to put in a lower low, so then demand takes in control, causing that change of character or that break of structure, right? We then get demand, right? So supply flipping to demand. Demand is now in control. So you could either literally just take your kind of higher time frame entry like that, essentially your risk entry on your higher time frame POI, or you can wait for price to come into your POI, drop down to your lower time frames, and then you're essentially just waiting for the exact same thing to happen, right? Price is obviously bearish on your lower time frame, coming into your higher time frame zone. Then you're waiting for the lower time frames to start to switch bullish, and then you look to get involved, and you have that confirmation that higher time frame higher low may be forming, right? And then we can do what? Target that weak high or even further. Then again, price comes into your next your next demand zone in this case, drop down to lower time frames, wait for order flow to start to switch bullish again to give you that confirmation that this zone is holding and that high low is in place, and then target that weak high. And that's it. That's really as simple as we need to keep it, right? In terms of just thinking about what it is we are trying to do here, and kind of those subtle differences between whether you want to just take that risk entry, whack your limit order on, or whether you're happy to then drop down to lower time frames and look for your confirmation entry. Now, another thing as well I do want to mention, if it kind of wasn't clear, is that you can use confirmation entries within your higher time frame POI without actually changing time frame. So for instance, let's say you were looking at this higher time frame POI, risk entry would just be whacking a limit order on there. But what you can do is actually wait. Let's say this is the 4-hour chart, this black line, if price was coming back and had a bit of a minor pullback, right? A bit of a minor pullback. And then you can get that 4-hour change of character here, right? Where you get that minor break of structure. And then price comes into this 4-hour zone here, right? This minor 4-hour zone. You haven't changed time frame, but you've essentially used the 4-hour to give you that confirmation entry within that 4-hour zone. Now, price isn't always going to do that. It's going to depend on how it's setting up, how big this actual range is, right? How big these swings are in price. Sometimes it's a very tight range. You're not going to get that much space on a 4-hour chart. It's going to tap in and go. But yeah, hopefully that makes sense of how you can essentially just use this, but without even changing time frames as well. So don't be afraid to kind of use that too. And then finally, what I was just saying, right, these are kind of, I guess in my eyes, the three main ways in which you can enter that zone. So whether you're using risk entry, confirmation entry, whatever, once you've actually picked that final last zone that you've drawn on your chart, and now you're ready to actually size up where your entry is going to be and where your stop loss is going to be, these are kind of the three main options. So main one being essentially always entering on the distal. So the distal is just essentially the edge of the zone. It's the very front edge of the box. And that is where you can put your entry order. Now, no matter how you enter your trades, stop losses, as I've been saying, they always go behind the zone, okay, no matter what. Now, how much of a pip buffer you give between the end of the zone and your stop loss, again, it's going to be down to each individual trader. This comes with time, experience, and testing, and it will depend on each individual pair as well, right? With how volatile they are, the average true range, depending on whether you want to give it half a pip, you want to give it 1 pip, 3 pips, whatever, or maybe some of you literally just want to go straight to there. That will also depend on how good the spreads are with your broker, etc. Things like that. I'm not going to dive into this too much for now. You're just going to have to test this and see what works for you. But in terms of the actual entry, the simplest way and the way I'd probably recommend all of you starting out to do is just use a distal. So always enter on the edge of the zone. And the reason why I say that is just because it's going to give you, you're going to be entering in a lot more trades if you do it this way, because obviously if you enter on the edge of the zone, when price comes in, you're going to get tagged in, compared to if you always enter on the EQ, sometimes price is going to come in and not tag you in. So this is the most unrefined way of entering, because risk to reward is obviously going to be lower compared to these ways, because your stop loss is going to be bigger, right? But I think when you're starting out, I think it's useful to just always enter on the edge, just so you're getting experience of getting in trades, getting used to managing them. You're just going to learn a lot quicker that way. And then the refinements come with time, okay? So the next, I guess, simple way to always enter trades is you always enter on the EQ of the zone, the equilibrium, the 50% level. And that's kind of why it's useful to draw your zones rather than drawing your entry zones with the box tool like this. You can either use a GAN box. So that's kind of a useful one. I'll just quickly show you the settings. Take a screenshot of that if you want to use a GAN box, okay? And that give you a line in the middle. I personally prefer to use, I believe it's called a fib channel. I have gone through this in the previous lesson. Let's have a quick look over here. Where are you? You're up over here. Actually, no, it's not a fib channel. I believe it's the parallel channel, isn't it? Yeah, there we go, just being blind. The parallel channel, which is in the trend line section. So that's what I personally use to draw my execution timeframe zones. So just click on that sort of the high of the candle, right? Then if you hold shift, it will draw a straight line. Then you can draw it to the bottom of the zone, wherever you want that to be. And there you go. And then you've got that perfect EQ in the middle. So just double click on that and you guys can see the settings there if you wish to copy that. And then that way you can always enter on the EQ no matter what, and your stop loss will always go behind the zone. So obviously the size of the zone that you draw will determine how big your stop loss is in terms of pips, and obviously then your risk to reward. And then the final way is essentially using a fixed stop loss. So this I kind of would only recommend for people who are a lot more advanced and who have done a lot of testing. You have essentially collected a ton of data, and you're very, because this will be very specific to what time frame you enter on, your style of trading, also specifically what pair you trade. It will differ from pair to pair because they're all slightly more volatile or less volatile than each other. So yeah, this is kind of the most refined way. And essentially all it means is that, let's say that you find for your style of trading on, let's say, euro dollar, you find that 5 pips, a 5 pip stop loss is the most optimal way for you to trade. Then what you would do when you've identified the zone that you want to trade on is you would just, for instance, like let's say I would go, okay, here's my zone. I know that I want a 5 pip stop. So what I would do is I would just move the risk to reward tool, knowing, okay, I want my stop to be about that far behind the zone. And because it's a fixed 5 pip stop, wherever the entry ends up, that's just where I'm going to enter. So for instance, if this zone was like a larger zone, well, you just do the same thing, right? You just size up your 5 pip stop. It has to be just behind the zone. That's where I want my stop to be. Okay, that means I'm now entering nearer the EQ. And obviously if it was a smaller zone, you may end up entering on the distal, right? And that's kind of quite a useful way to trade, okay? But this will come with just essentially testing, figuring out kind of what average strike rate you have, what average risk reward you need to achieve, and kind of playing with the numbers a little bit more that way. But yeah, it's definitely not one I would recommend for when you're first starting out. When you're first starting out, I'd keep it very, very simple and either always enter on the distal, always enter on the EQ, and your stop loss is always going to be obviously just behind the zone. That's kind of, your 3 kind of main ways in which you guys can start to experiment and test with as we dive into it. So yeah, that wraps it up. In very, very simple terms, we have either risk entries or confirmation entries. We've kind of gone through the pros and cons of those. Risk entry is literally just entering on the zone. Confirmation entry is obviously using those lower time frames, those fractal refinements to just kind of help you wait for the trend on those time frames to switch in favor, to just show you that higher time frame POI is going to hold. And then these 3 ways here is literally just whether you can just bring that refinement of that zone even further. So now let's take a quick look at an example of using what we just learned in the actual market. So we're just going to look at a couple of trade examples, really just kind of showing you the difference between risk entry, confirmation entries, and double confirmation entries in the live market. And then of course the kind of those 3 main ways in which you can actually enter on that zone once you've kind of built the story and picked the zone that you wish to execute your trade on. So kind of just going to do a quick kind of rough and ready analysis on euro dollar, literally just analyzing today's price action. It's currently Tuesday the 21st of September 2021. So yeah, I'm not going to just kind of go back and find the most utopian perfect trade example for you. Literally just showing you literally every single day the same patterns occur, the same way we can trade the market. And just kind of show you that. So daily chart, reasonably similar to the examples that we've been building throughout the lesson so far. We know that we've been trading within this larger, big, bullish weekly range, price currently is tapping into this liquidity sweep zone, right? There's going to be some demand left within this wick, which we initially had a reaction off, but we failed to take out that weekly high. Price then came back down and took out this weekly low here and tapped into some remaining demand within this sweep zone down here. So the daily chart, if we kind of simplify it even more, has been in a clear bearish trend, forming those swing lower highs and lower lows. Then price did take out this weak low, right, sweeping that liquidity, tapping into the remaining demand that is left within this wick, and it did have a pretty decent bullish reaction, taking out this more minor high here, and it tried to form that clear higher high, breaking this more major swing high up here. However, it literally wicked that high by about a pip or so. It barely, broke it. Obviously didn't close above it, and we didn't get that type 1 break of structure, so no higher high there for me. Essentially just tapping into that external range liquidity and then retracing pretty aggressively to the downside. So the daily chart is kind of coming down into this extreme zone here. So there is the potential that price could form a decent reaction from here and actually go on to make higher highs, because it did take out this high here, but for me that's kind of more of a minor high than a true swing high. I would have really wanted to have seen this high get closed and broken above to be a lot more convinced that price was going to go and push on higher. Which obviously could happen, right? We could react from here and go. I have no idea. I don't have a crystal ball, but based on my analysis, I would say the higher probability is that this low here is a weak daily low, because it failed to create a higher high. It failed to take out that swing high for me. It failed to get a true close above it. So we may just see a bit of a short-term reaction here, and then we could see a run of that low there to form a much clearer lower low. So based on that, as price comes down into here, you can look to trade this reaction and look for some short-term longs to trade a bit of a pullback there. So let's have a look on the 4-hour chart and see if we can refine our daily zone even more. So we kind of had two main areas, I would say, on the 4-hour chart. You could either take that whole range there, right, that 4-hour range, just draw this box on for the 4-hour chart, or refine it to that single pivot created demand down here. Drag these across a little bit. All right. Or the next one, which price is near approaching, is this more decisional demand zone here, where we can take that single candle, or you can of course just take the whole range. Not a massive difference there, and I'm going to be kind of using lower time frames here to look for different entries. So I guess, yeah, a risk entry from a 4-hour perspective, you could literally just set one on that 4-hour zone there, stop just below the low. Of course you could set it on the EQ, or you could set one down here, right, and that essentially would be your risk entry. But for the sake of this example, we're going to drop down to the lower time frames to see if we can get those lower time frame entries to essentially just play a reaction from this daily zone and these 4-hour zones to see if we can get a bit of a pullback. Counter trend trading, obviously we'll talk about management in the upcoming lesson, but obviously we wouldn't want to push it too far, because we would really kind of expect this bearish order flow to stay until it doesn't, and potentially looking for price to come up in towards these supply zones and continue the overall bearish movement. We can clearly see, looking at the 4-hour recent price action, right, how corrective and slow those pullbacks are, and then sharp aggressive movements down, right. Supply is clearly in control. So what I would be doing in the live market, setting my alerts in this zone and wait for price to come into there. But yeah, let's see if we can kind of wait for the 15 minutes to give us that change of character and start to switch bullish as it comes into our zone. So I'm just going to kind of play this slowly forward. So price is starting to build a bit of liquidity. You can see we had those relatively equal lows right there, and again equal lows there, building that liquidity coming into our zone. So now I'll just be waiting for price to switch bullish and give us a bit of a change of character. So nice bit of momentum there, and now we clearly have that minor break of structure to the upside there with that change of character, giving me a very nice zone down here, which you could pretty much classify as a sweep zone as well. In my opinion, took the liquidity from those lows there. Nice aggressive, move in, aggressive move out, showing that clearly that demand was filled, causing that change of character with that minor break of structure there. So now what I would do, well, one thing you can do is you could literally set your limit order here, right, and trade that M15. So kind of it can get a bit confusing then when you're jumping through time frames and how you define confirmation or risk entry, because essentially if you're trading the 4-hour zone, your 4-hour, if you're trading a 4-hour POI and then you use this M15 zone as your execution time frame, this essentially would be your M15 confirmation entry, because you're using the M15 to confirm your 4-hour zone, right? So if you were to set your limit order here, that essentially would be kind of your M15 confirmation entry. But what I'm going to do is I'm going to drop down a time frame to the M1. and I'm going to essentially trade the M15 POI. That's obviously nested within the 4-hour daily, but I'm directly trading the M15 POI, this blue zone here, by using an M1 confirmation entry. So what that means is that I want to trade the M15 POI, but I'm waiting for the M1 to confirm that the M15 POI is going to hold, right? So I want to see that switch bullish, ideally get that flip zone within there as well, that structural zone, right? To then look to trade and then see if we can use that confirmation on the M1 to essentially confirm the M15 POI. But like I said, you don't have to do that. You could literally just enter on the M15 zone if you wish to do so. So just going to kind of fast forward this until price comes down to our zone. If it does so, let's see. So it's just chopping around, kind of coming into, let's see what the time is now. So 12:50 London time, that's coming just into New York, sort of 1 p.m. All right, so now, let me zoom in, we've literally just tapped the zone. So if you had your alert on the zone, that would now have gone off. We've set liquidity into that zone. So now I just want to see the M1 start to switch bullish. So we're just chopping around at this moment. It hasn't formed a lower low or a lower high. So I'd be essentially looking at this as my M1 supply zone, right? So I'd want to see this fail and M1 break higher up above this high here. So that would give me my M1 change of character. So tapping into that, and then we break up above it, but on the M1 we fail to close above that high there, and then we start to shoot off. Let's see, does it come back? No, not really. So in this case, the M1's getting pretty ugly. There wouldn't really be anywhere I'd kind of want to set an entry order there. But what I can see and guess is that on the 15-second, there was probably a clean entry. Because if you remember what I was saying, the difference between using type 1 or type 2 for your S&D flips is with a type 1, which is where we just get the wick break. It's not as kind of confirmed if you were to then enter as price comes back to the zone because you failed to close above. But the reason why some people are happy to use a wick break, like with this candle here, bang on 1 o'clock, is because on the lower time frame, it would have closed above, and then it would have come back right here, and then tapped you in, and then you'd be in the trade. So if I kind of show you, let's see if the 15-second will load for me. Here we go. Yeah, so you can see how clear that is now if I zoom in. So what would have happened if you were looking at this on the 15-second is price went up, obviously clearly closed well above that, and then you would have been looking to enter essentially within the sell to buy. Obviously you could refine it to that M1 inside bar, and then that would be your entry order there, and then you can either set your limit or enter at market as price and returns. You can get away with a 1 pip stop, probably be a bit more lenient, 1.5 pips, or you can obviously take the whole range, 2 pips there, right? And then you would be in the trade that way if you took the seconds time frame entry. But obviously on the M1 it doesn't really give you an entry there. So let's fast forward this a little bit more and see if we do get an M1 confirmation entry. So next kind of area of supply we're looking at is this range here. All right, you can take the whole range, or you can refine it to kind of, this candle area here, which we can see prices coming into. We're having a bit of a reaction. So this now should form a lower low. Let's see. Okay, so now we've closed, or no, we haven't closed, but we've spiked up above that high. So let's wait for, let's see if we can get an M1 close. So now we have an M1 close above the reaction, right? So we have that confirmed failed reaction. So now what that means is you can technically enter anywhere on that sell to buy price action, right? Anywhere within this candle here. So this is where you kind of have your options open, right? So let's say this is a zone you want to enter on. You can either enter on the distal, and then you will put your stop behind there, right? So probably want to give that a bit of a buffer, I'd say 2.5 pips. Or you can enter on the EQ, or you could say, well, I'm the type of trader who always wants a 2 pip stop. So in that case, you would then just do that, and that would essentially determine where your entry point is, right? Or you can potentially move it a little bit closer. So let's see if you get tagged in. So then you would get tagged in that case, and then you'd be in the trade. So let's see how this plays out. So you'd still be in the trade at this point. Again, we'll talk about management in a bit, but you'll see in the next lesson that running at 2.5 definitely wouldn't really want to move that to break even at that point. You'd want to let it run a little bit more. But yeah, we'll talk about management in the next lesson, and then you'd be in that trade. So essentially what you've done here is we are playing essentially that daily and 4-hour pullback, right? Remember, from this large daily zone, we were refined to 2 4-hour zones, so the decisional and then the origin extreme down here. We then waited for price to come in, and we're essentially using the M15 as confirmation of which zone is likely going to hold first, so we can play a reaction from here. So that's one we got. If I show you on the M15, Right, that's why we waited for the M15 to switch bullish. We got that change of character. We created a sweep zone, right? That demand zone, price came into it, which we could have traded directly. So that would have been an M15 confirmation entry of a 4-hour zone. Or maybe, the M15 is just a time frame that you use POIs from. So this would be your main time frame to look to build trade ideas around. Then essentially that would classify as a risk entry, I guess, and then you would be jumping down to the M1 for your confirmation entry, if that makes sense. So you wait for the M1 to tap into it, you wait for the M1 to switch bullish for demand to get in control. There wasn't really a clean M1 entry there for me, much clearer on the 15 seconds if you use that time frame. Otherwise, for me, this is the first valid M1 entry where we get that flip occurring, that exchange, right, that reaction. The reaction fails, price pulls back into it. You get another opportunity to get back in here, right, as it fills up more entries, or more demand, I should say, more orders within lower in the zone. And then we go. There would have been another 15-second entry here, as you can see, right, price comes back in. It would have been a lower time frame confirmation, and then you could have traded this move off and away. So yeah, hopefully you can kind of see the differences there between the time frames and kind of how you can classify that as risk entry or confirmation entry. I wouldn't get too caught up on it and too confused about it if it's confusing. It's more just kind of trying to separate those out in your mind of really what those mean. So then if we kind of fast forward this, see how far price plays out. So this is kind of around Asian sessions, so I wouldn't be trading around this time to kind of bring this to pre-London. See, so around 7 a.m. is Frankfurt, so around this time here. So we've had another M15 break of structure, right? So we're getting that bullish order flow starting to kick in, but remember it's counter the 4-hour and daily trend, so we don't want to be pushing this too far. So at this point, it's kind of a couple areas I'd be looking at, this being the most obvious zone here. Right, and then the only thing I don't like about this is there's pretty obvious liquidity sitting below it, right? All of those equal lows here. If I can get the line to work, there we go. So I'd be a bit cautious of that, and we may come a little bit lower before we go. So where do we have this orange origin demand zone that's been unmitigated down here, right? If you just follow the series of mitigations, and kind of another obvious one I would see is this, is it a flip zone? Let's see. So that candle's unmitigated, but did it react? So what I'm essentially looking at is this whole range here, right? This buy to sell range on the M15. So we drag it across, right? And we can see that price pulled in, whoops, so it moved in, and then that sell to buy range, right, caused a reaction, and then that's where the demand came in to kind of break those highs and take out that zone there. So obviously price did come back into the top of the zone, reacted and pushed away, but we do have an unmitigated zone below it, which has nice inducement above. So I'd look to trade from either of these zones. So then what we can do is obviously you can set limits on order on either of them, right? Take those kind of risk entries, or you can drop down to your execution time frame. So let's take a look at the M1 and then just wait for price to come into those zones, and let's see if we get entries. So price comes in. Okay, so now we're looking to see if the M1 switches bullish. Okay, nice big aggressive move away, swept all of this liquidity here, big movement in and out. So then I would essentially be looking at this M1 entry here. Now this isn't really a flip zone for me, this is more just a structural zone. So yeah, I do prefer flip zones, but yeah, it's still got decent enough confidence to look to trade from. So let's see how big this would be. So if you were entering on the distal, bit of a safe buffer, again 2.5 pips, or whether you enter on the EQ, or whether you're, let's say you're a 2-pip stop trader, then you would enter there, right? Because it just depends on where your stop loss is, will determine where your entry is. So let's see if we get tagged in. So no tag there, doesn't break the high, so you leave your order on, and then it ends up being a loss. Okay, absolutely fine. Just trying to show you here, right? Losses are more than valid. This was a decent area in my opinion. Yes, there's liquidity below. That looks like price is now looking to sweep, but we never know whether price will sweep it or not. So we always react to it and not predict. So let's see if we can get a decent reaction from the lower zone. Let's see what happens if and when price reaches there. So a pretty aggressive move in and a pretty aggressive move out. Let's just wait for the M1 to switch bearish. So we kind of have this whole M1 range here. Drag this out of the way. Okay, so there's our M1 zone. So let's see if supply is going to hold. So we're getting a reaction, and then we get a closure above and that change of character. So that would be your M1 chock, and then this would be where the reaction is, right? Those inside bars. So that would be the reaction failing. So then you can enter anywhere within here. I've not drawn that accurately at all. Let's get it on there. There we go. and then down to here, and then that would be essentially your confirmation entry of the lower M15 zone. So again, if you were to enter straight on this M15 zone, whack a limit on the distal, right? If you're just an M15 trader, trading the M15 POI directly, stop below the low, probably 7 pip stop, that would be your position there. That would be essentially your M15 risk entry. Maybe you want a confirmation entry, so you drop down to your low time frame execution, wait for the M1 chock and the flip. There's your entry there. Let's see if we get tagged in or not. So we've got another minor break of structure, prices come back in, and then boom, there's your nice movement away. So there's your confirmation entry. What do we get? We get another break of structure. There's no exchange between demand and supply there, so there's no flip. We kind of just smash straight up through, but we do have these kind of pretty clean M1. In fact, I'll draw this zone here, right, on these two candles here, where then you could get your double confirmation entry. So this would be your first initial position on a confirmation entry. Now, whether you took this, you can scale in here or look to scale in, or now you've got double confirmation, right? You're seeing demand starting to hold. We've had a double break of structure. We've seen this supply to demand flip here. We've created another area of demand. So then this would be my double confirmation entry here, right? So then let's just say you take a 2 pip stop, nice and conservative below the low there, and then that can be another entry there. And then let's see, kind of still part of one up move. So I personally view that kind of as one just big push, and then looking to see if price can come back to the origin or not. Leave your order on, let's see, and you don't get tagged in. So yeah, that's the kind of the thing, right? You can get extra confirmation, but you run the risk of potentially price not pulling all the way back and tagging you in this case, okay? So that would be your risk entry down here. That would be your M1 confirmation entry, and then that would have been your double confirmation entry down here. But yeah, you end up not getting in there. Yeah, is what it is. The only thing you could potentially have done, I'm just looking at this now to see how you could have got in, is let's say you're looking at the extreme, but price starts to move away and starts to break structure to the upside. Well, what you can do is realize that actually price might not come back to mitigate that exact refined M1 level of demand, and actually it's just, you know, reacting to this whole sell to buy region, because if you were to jump up to the M5, essentially this would be like an M5 demand zone, right? But then if you see M1 starting to react and move away, we get those minor breaks of structure, then potentially, you know, you may want to enter on that next level of demand, which would be here, and that's how you could have got into the trade if you entered on the distal. So not necessarily saying that will be in your trade plan or a position you may want to take. You may always want to wait for price to come down to the extreme, but I'm just kind of showing you an example of here of potentially if price starts to move away, right, it breaks structure to the upside here, it creates another level of demand. That is how you can get in, rather than always waiting for price to come in and tag you in. But yeah, that's kind of as simple as you need to keep it. Risk entry on the M15 zone, M1 confirmation entry, and that would have been a tidy double confirmation entry if it entered you in, but it didn't in this case. And obviously how you enter on the zones, distal, EQ, or have a fixed stop loss. But yeah, when you're first starting out, I definitely recommend just always taking it on the distal, just to kind of get in more trades, get more experience, more exposure. You get to journal more, you get to, you know, just, yeah, for obvious reasons, right? Refine it a bit more to the EQ. It's very, very simple, and you just instantly double your RR for when you do get tagged in, of course. And then, yeah, then you can really start to refine and play around with fixed stop losses. Only once you've collected a ton of data on what kind of is the most optimal for you, for your style, for the time frames you execute on, and obviously for each individual specific pair. Because a 2 pip stop loss on euro dollar is going to be, well, it can work out okay maybe for you, but if you put that 2 pip stop loss on a pair like pound yen, you will quickly see that that is tiny and it's not going to cover you at all, because pound yen has a much higher average true range. But yeah, I'll leave it there before I rant on about that any longer. Hopefully that makes a lot more sense about entries, and then we'll talk about this in a lot more depth of how you can tailor this and personalize this to your own kind of style as we look to create our trade plans.